So friends, today we are starting with a new chapter called Pricing and Valuation of Forward Commitments. So forward commitment means we are mainly talking about forwards, futures and swaps. So friends, here we try to understand how to do the pricing and valuation of forwards, futures and swaps. Now how do we do that? Friends, there is a concept called law of one price. This basically says that an identical asset will be priced identically. Or we can put it in words in this way: identical assets sell for identical price. So two assets, if they are identical in nature, in their performance, in their fundamentals, their pricing should be the same. Or in other words, there is no scope of arbitrage. Arbitrage means two identical assets selling for different prices, and there is a scope of making a profit mostly equal to the risk-free rate by selling the higher one and buying the lower one, right? So there is no scope of arbitrage. This is our assumption, friends, which means the law of one price persists. Now how are we going to use it? Let's take the example of forwards. Now friends, let's say an investor has gone short forward and the investor wants to cover this position. One way is to go long forward, right? One way is to long forward, or the other way is to go long a synthetic forward. So what is a synthetic long forward, friends? It is basically a combination of long underlying asset and borrowing of funds and borrowing fund to do the same. So borrowing fund and using the fund to go long on an underlying asset which is pertaining to the forward contract, right? So this is what we mean by short forward being covered by a synthetic long forward. Now friends, if the law of one price has to persist between this synthetic forward and this short forward, then the value of the short forward has to be equal to the value of the synthetic long forward. Right, friends? The magnitude has to be same. That is the only way the coverage can happen. And this is the principle we will use to do valuation of forwards, and not only forward, we'll use the same principle for valuing other forward commitments also. So friends, this is going to be a valuation modus operandi, right? But first, let us find out the value of a forward at expiry. So value of a forward at expiry. To the long forward, it is plus Vt, let's say, V capital T being the time of expiry. So plus Vt is equal to plus St minus F0, friends. F0 being the forward contract value at t is equal to 0 and St being the spot price at t, right? Right, friends? So friends, the long forward benefits if St is greater than F0, and the long forward loses money if F0 is greater than St, because obviously this value becomes negative. Now what about the short forward? That is the person who has sold the forward contract. The value is completely opposite, friends. It is F0 minus St or plus F0 minus St. So at expiry, the seller of the forward contract benefits if F0 is greater than St, and the seller loses if St is greater than F0. Right, friends? This is the value at expiry. And what is the value at initiation, friends? Value at initiation of the forward contract, value at t is equal to 0 of the forward contract. This is for the long forward and the short forward both equal to 0. So plus V0 is equal to minus V0 is equal to 0, because no transaction is taking place, generally speaking. So the initial value is 0 and the final value is the difference between the spot price at expiry and the contract forward price, right? Now friends, let us use this law of one price principle and try to value the future contract. Now friends, here ST is visible, right? ST is visible. Even if you want to know S0, that is also visible, spot price at initiation of the contract. The only thing that we have to determine is the F0. So how do we do it, friends? We use the principle of no arbitrage or principle of law of one price to get the value of F0. So friends, the method that we use is called the carry arbitrage. Why is it called the carry arbitrage, friends? Let's say a person has short sold a forward contract. Short forward. Now, if the person wants to cover this, as we have spoken earlier, what he or she has to do, friends? He has to go long the underlying by using borrowed funds. So combination of borrowing funds and using those funds to go long the underlying. This is basically the way to cover for the short forward. Now these two basically are identical assets in reverse directions, right friends? So the absolute value of this for no arbitrage has to be same. So for no arbitrage, the absolute value of the short forward has to be same as the absolute value of the long forward or the synthetic long forward. This is the synthetic long forward and this is the short forward that we are talking about. The absolute values have to be same, only the direction has to be reversed because we are talking about covering one with the other, right? Now friends, what we will do is we will use this case of shorting a forward and covering it with a synthetic long forward. Simultaneously, we will use this case to find out the value of F0. Okay friends, so let's get started. Now friends, let's say the contract initiates at t is equal to 0 and expires at t is equal to capital T. So one has gone short forward, right? Short forward. Now value at t is equal to 0, V0 is equal to 0 for this short forward. Now the value at expiry for the short seller is minus V capital T is equal to F0 minus ST, where ST is the spot price at time T and F0 is the forward contract price, right? This is the value to the seller of the forward contract. Now, the seller has also done something else. The seller has created a synthetic long position in the forward also. So how that has been done? That has been done by borrowing funds and buying the underlying with it. Right friends? So we try to assess the value of this synthetic position also separately. So let's say the price of this underlying asset at t is equal to 0 is S0. Okay friends? So if we go long the underlying asset, the cash outflow will be S0. So the cash flow is minus S0. Let's say we have bought this underlying or gone long this underlying asset by borrowing the funds. So the cash inflow by borrowing the funds has been S0 plus. Right friends? So for this synthetic position, the value at t is equal to 0, let's say V dashed 0 is equal to 0 because plus S0 minus S0 becomes 0. Now what is the value of this position at expiry, friends? Let's understand that. Borrowing funds worth S0. So one has to return it at t is equal to capital T. So let's say this cash outflow amounts to S0 multiplied by 1 plus the interest to the power the expiry time. Now what is this interest rate R, friends? This R is nothing but the risk-free rate. The risk-free rate. So when we are talking about creating the synthetic position, we are talking about borrowing at risk-free rate only. Right friends? So this R is the risk-free rate. Now the spot price is obviously ST at expiry. So if the asset the underlying asset is sold at T is equal to capital T, then the cash inflow is capital ST plus. So the value of this synthetic position V dashed capital T is equal to ST minus S0 multiplied by 1 plus R to the power T, nothing else. Now, for no arbitrage to happen, Vt dashed minus Vt should be equal to 0. Right, friends? Vt dashed minus Vt should be equal to 0, which means St minus S0 multiplied by 1 plus R to the power T plus F0 minus St should be equal to 0. Now friends, this St and St cancel out. So what we are left with is F0 is equal to S0 multiplied by 1 plus the risk-free rate to the power the time of expiry of the forward contract. This is how we ascertain the price for F0. F0 is priced at S0 into 1 plus R to the power capital T. Okay friends, this is pricing of F0. Now friends, for simplicity's sake, what we have done is we have assumed that R is the risk-free rate, right? But this is practically not exactly the way it is done. Practically what is done is the market prices of these contracts are checked and from them the interest rates are derived, right? So let's say if you are looking at a T-bill and you want to find out the rate of the T-bill, you look at the price of the T-bill, and from that you imply the rate for the T-bill. So it is the reverse way around. Anyways, so we will take one more example, one more specification here. Let's say this R is a continuously compounded rate. R is a continuously compounded rate. Then what will this F0 look like? Simply friends, this F0 will look like F0 is equal to S0 multiplied by e to the power RC multiplied by T. So this is the expression for a continuously compounded interest rate. Now friends, we'll move to something called the reverse carry arbitrage. Reverse carry arbitrage. So why we are doing it friends? Initially we had gone short forwards, right? We had gone short forward and we had covered it with borrowing of funds and going long the underlying. So borrowing funds plus long the underlying. So we had gone short forward and covered it with borrowing of funds and going long the underlying. Now we want to understand that if we can do the same thing or create a synthetic position with respect to a long forward, friends. Can we do that? Definitely. If we go long forward, then the coverage will happen in the reverse direction, right? What does that mean? That means short the underlying and lend that money. Short the underlying and lend the funds that you get from shorting the underlying. Now this one is called a reverse carry arbitrage. So we remove the simple carry arbitrage now. So when we are trying to arrive at F0 through a long forward and a synthetic cover for it, then the process is called reverse carry arbitrage. So we know the drill already, friends, right? So we just replicate it for the long forward position. At t is equal to 0, we go long forward. And to cover for it, we create a synthetic position which consists of shorting the underlying and lending the funds accrued through that. Right, friends? So we are at t is equal to 0. Value of the long forward obviously is equal to 0. V0 is equal to 0, right? Now, shorting the underlying. Let's say the spot price at t is equal to 0 for the underlying is S0. So, shorting the underlying means there is an inflow of cash. So, plus S0. So, this synthetic position, the first part of it creates a cash inflow of S0 and lending the funds that will create a cash outflow. So we have lent the entire funds that we have accrued by shorting the underlying. So the cash outflow is minus S0. So the total value of this synthetic position V dash 0 is also equal to 0 because plus S0 minus S0 is equal to 0. Now let's say the forward contract expires at T is equal to capital T. What is the value, friends? Vt is equal to S capital T minus F0, where F0 is the contract price at initiation of the forward contract and ST is the spot price at expiry. T is equal to capital T. So this is the value of the forward position. Now what is the value of the synthetic position, friends? We have to look at the cash flows of the two legs of this synthetic position separately. So first we have shorted the underlying. So we have to buy back the stock. This will be minus ST cash flow because this is the spot price at expiry, right? And we have lent the funds. So we'll get the money back. This means there will be a cash inflow S0 multiplied by 1 plus the interest rate to the power T. So the value of this synthetic position, this position V dash T is equal to S0 1 plus R to the power T minus S capital T. Now, for the no arbitrage condition to be satisfied, Vt plus V dash T should be equal to 0. This implies, if we just simplify these two equations here, friends, we can obviously see that St minus F0 plus S0 1 plus R to the power T minus St should be equal to 0. St cancel out, which means F0 becomes S0 1 plus R to the power T. Now we will not get into the complication of whether this is a risk-free rate or this is a continuously compounded rate or this is a different interest rate altogether derived from the market rate. We will not get into all these complications. We will write a simpler form of F0, friends. F0 is equal to future value Fv of S0. It can be continuously compounded, it can be periodically compounded, that doesn't matter. This is the expression that will take forward. So this is the expression that will be taken forward from here, friends. Now, friends, a few concepts we have to understand before we go further. So friends, we'll try to understand these three concepts: convergence, cost of carry, and carry benefits. So we have already touched upon this in the previous levels of CFA, but here also we will just rewind them, right? Revise them a little bit. First, let us understand what is convergence. Convergence means as the time to expiry approaches, the value or the price of the forward or the future contract comes nearer and nearer to the spot price at expiry. As the time of expiry approaches, the price of the forward or futures contract comes nearer and nearer to the spot price at expiry. Let's say there are two forward contracts whose expiry time is T is equal to capital T. Right? One initiates 3 months before capital T. T is equal to T minus 3 months. And the other initiates 6 months before capital T. T is equal to T minus 6 months. Okay. So this is the first contract. This is the second contract. Let's say that contract prices at initiation for these two contracts are F10 and F20 respectively. And the spot price of the underlying is ST. Okay, friends. Now the convergence theory says that the difference between ST and F20 will be less than ST and F10. That is, F10 will be further away from ST than F20. So this is what the convergence theory talks about. Now we'll understand cost of carry and carry benefits. Let's see what they are. Let's say you are holding some agricultural assets, for example rice. Now you want to sell it forward in 3 months. Now for these 3 months you have to store the rice. Storing means there is some inventory costs to it. Let's say if there were no inventory costs, you would have settled for F0. This contract you would have settled for F0. But now because there are inventory costs, you will add some value to it. F0 plus cost of carry. Cost of carry means you will be carrying the rice for 3 months or storing the rice for 3 months and there is a cost to it. So you add that cost of carry to the forward contract. So your final forward contract price becomes F0 plus cost of carry or CC. This is what cost of carry basically means. So to define it, cost of carry is the cost incurred pertaining to the asset from the time of initiation of the forward contract till its expiry. Cost of carry is the cost incurred pertaining to the asset from the time of initiation of a forward commitment till its expiry or maturity. Right, friends? And similarly, what is carry benefit? You can understand from this. We can derive it from here only. Let's say you are holding some stock or some equity and you are trying to sell a forward contract pertaining to this. Now, the forward contract matures at time capital T. Now, from time 0 to T, in between there is a period T is equal to small t, where there is a dividend being paid by the stock. So this is a benefit that you are getting for holding the asset till maturity. The contract has already initiated at t is equal to 0, right? The contract has already initiated at t is equal to 0, but because you are holding the asset, you are getting the benefit at t is equal to t, which is before the maturity time, right? If without this benefit, the contract price was F0, because of this benefit, this will become F0 minus carry benefits. This will be the final contract price, friends. This is what we mean by carry benefits. So to define it, carry benefits are the benefits accrued pertaining to the asset from the time of initiation of a forward commitment till its expiry or maturity. Now friends, what about the convergence theory when there are carry costs and carry benefits both? Let's have a look at that. Now friends, let's say an underlying has a spot price, initial spot price of S0. Present value of its carry cost is PV of CC, and present value of its carry benefits is PV of CB. Now friends, if you have to devise a forward contract price from these three factors that we know, how can we draw it? F0 is equal to future value of this spot price of the underlying plus the present value of the carry costs minus the present value of the carry benefits. So F0 can be written as future value of the underlying plus future value of the present value of carry costs minus carry benefits. Right, friends? So if this portion is greater than 0, that implies F0 will be greater than FV of F0. Right, friends? And if this portion is less than 0, then F0 will be less than FV of S0. Now friends, when will this be greater than 0? When CC is greater than CB. Right? When CC is greater than CB, this value will be positive, and therefore this entire portion will be greater than 0. And if this portion is negative, CC less than CB, that will imply this entire portion will be less than 0. Right? So friends, what we can do is, we can draw a pictorial format of this convergence theory by adding these two factors, CC greater than CB or CC less than CB. How does it look like? Let's say FV of S0 lies at this point. Therefore, if CC is greater than CB, then F0 will lie some point above it, right? And if CB is greater than CC, then F0 will be some point below this value. Now, this is at t is equal to T1, and the expiry is at t is equal to capital T. Now let's take another time. T is equal to T2, which is nearer to capital T. Here friends, FV of S0 will be nearer to the spot price. Let's say the spot price is ST. So friends, at T is equal to T2, the future value of S0 should be nearer to the spot price. This is farther away, this is nearer, right? Now friends, these two points at T2 will come down a little bit. They'll come to somewhere here, let's say. Why they will come down, friends? Let's illustrate that. Future value of the present value of this difference, CC minus CB. Let's say we are doing sort of a periodic compounding. This will look like PV of CC minus CB multiplied by 1 plus R to the power T minus T1 for the first period, right friends? T minus T1. And for the second period, this will be, if we write this FV1, FV2, PV CC minus CB, this will be equal to PV of CC minus CB multiplied by 1 plus R T minus T2. Now friends, everything is same. 1 plus R is same, PV CC minus CB is same, capital T is same. The only things that vary is T1 and T2. Now friends, T minus T1 is obviously larger than T minus T2. This is larger. So this value, this V1 will be greater than this V2. V1 will be greater than V2. So in either case, even if it is positive or it is negative, the values will come closer to FVS0. That is why these points have come down. And the closer we get, this trend will follow. So this will come even closer, let's say. This is FVS0, which is even closer to ST. And these points have also come downwards further. Right friends? And at T is equal to T, ST and FVS0 merge. Let's say this is that point. Now, we can draw lines to join these trends. This is the line which shows that as the maturity or the expiry comes closer, the future value of S0 approaches the spot price at expiry. And the carry cost, carry benefit aspect, the impact of that also comes down as the expiry approaches. Right, friends? So this is what we are talking about. So this is the way we combine the concepts of convergence, carry benefits and carry costs. Now friends, we'll move on to the next step. Valuing a current forward contract. Let's say we have entered a long forward contract at t is equal to 0 and the contract price is F0. This is a long forward contract. Okay. Its expiry is at t is equal to capital T. And we want to find out its value at an interim period t is equal to small t, or the current period, let's say. Now friends, let's say the spot price of the underlying at these times is S0 for t is equal to 0, S small t for t is equal to small t, and S capital T for t is equal to capital T. Therefore, the value of this forward contract at expiry Vt is given by St minus F0. Now, what is the value at this interim period, friends? V small t, what is it? This is naturally S small t minus present value at small t of F0, or we can write it Vt is equal to St minus F0 divided by 1 plus R to the power t minus t. R, let's say, is the compounding rate here, and t minus t is this distance, friends. So obviously, to get the present value, we have to discount with respect to the time and the rate of compounding. So that's what we have done. So value of a current forward contract can be given like this. Now friends, we'll try to derive the same thing through a different route. Let's say at t is equal to 0, we have gone long forward. And as usual, the contract price is F0. The expiry is at t is equal to capital T. Okay friends. Now we want to find out the current value. The current time is t is equal to small t and we want to find out the value here. Now to find it out, we do something different, friends. What we do? We go short a forward contract. We go short forward. The contract price, let's give it the name F small t. Now what is the value of this F small t, friends? F small t is equal to is nothing but the future value of the spot price at small t, right? FV of S small t, right? So let's say we have a compounding rate as usual of small r. So this becomes St multiplied by 1 plus r to the power the time. The time is what? This time is capital T minus small t, right? So this is t minus t. This implies St is equal to nothing but Ft by 1 plus r t minus small t, right? Now we use this expression in our previous value formula. Now Vt, we had written previously, this is equal to St minus F0 1 plus r capital T minus small t. This we can write as F small t by 1 plus r to the power t minus small t minus F0 divided by 1 plus r t minus small t. Now this can be rewritten. This is equal to Ft minus F0 by 1 plus r capital T minus small t. So in effect, Vt is nothing but present value of Ft minus F0 at t. So this is the value of a current long forward contract. And what is the value of a current short forward contract? Obviously the reverse. Minus Vt is equal to present value of F0 minus Ft at t. We can also write it in this manner. Minus Vt is equal to F0 by 1 plus R capital T minus small t minus St. Right, friends? So this is the way we do a valuation of a current forward contract or a forward contract at an interim period in somewhere in between initiation and expiry.